Before I get into this presentation, I want to remind everybody I'm wearing my purple tie. And the reason I'm wearing my purple tie is to remind every one of you that I'm a data-driven centrist. I'm not a Republican. I'm not a Democrat. I don't vote Republican. I don't vote Democrat. I'm a thoughtful, dispassionate, data-driven investor. I don't believe that you can be a great investor if you lean too far to the left or too far to the right politically. That's just my own personal belief. And this is why, in our opinion, we continue to, our results continue to reflect the way that our results look the way they do in your portfolios because I'm a purple tie investor as opposed to a red tie or a blue tie investor. So I hope you guys appreciate that. So if you hear anything today that, rubs you the wrong way because you're a Republican or rubs you the wrong way because you're a Democrat, I don't care, quite frankly, but just be aware that it's not coming from a politicized place. So just be aware of that. But obviously, we got to talk politics because in a fiscal dominance regime, hello, if you're not talking politics and the pivot to paradigm B, or the pivot from paradigm A to paradigm B to paradigm C, if you're not talking politics, you're missing 90% of what matters to financial markets this year. So you can bury your head in the sand if you want to, but we're not going to bury our heads in the sand. We're going to run the ball right up the middle and score a touchdown, just like my buddy Marshawn Lynch. So get into it. To have conviction in where the economy and asset markets are headed in paradigm C, you must first understand paradigms A and B. Again, to have conviction in where the economy and asset markets are headed in paradigm C, you must first understand paradigms A and B and understand why we're not going back there. Crippling wealth and crippling income and wealth inequality, plus a 40-year high in inflation, plus a historic crowding out of median households and small to medium-sized enterprises is why the electoral college map looked like this last November. Like, to me, this is one of the most important images I've ever seen in my entire life. In my entire life, not just as a research analyst, not as a institutional macro risk manager, just as a human being. I was like, wow, what a signal. What a signal. Tells me that the whoever's in the blue zones need to figure something out. Because the people in the red zones have figured something out. And it's telling you that they don't like crippling income and wealth inequality. They don't like 40-year highs in inflation, and they don't like being crowded out to a historic degree. And so they're going to vote for something different. Anything different. Could be a felon. Who cares? Just as long as it's different. And then finally, there is abundant evidence of Republican tax cuts catalyzing durable positive shocks to the federal debt. So if you look at the current year for the first Reagan tax cuts relative to the subsequent 5 to 10 years, that was a durable positive shock to federal debt. If you look at the second Reagan tax cuts at 46% relative to the subsequent 5 to 10-year mean, that was a durable positive shock to the federal debt. If you look at the first Bush tax cuts, 41% relative to the subsequent 5 to 10-year mean, that was a durable positive shock to federal debt. If you look at the second Bush tax cuts, starting at 45% relative to the subsequent 5 to 10-year mean, that was a fourth durable positive shock to federal debt. And then if you look at the Tax Cuts and Jobs Act, starting at 88% in terms of the debt-GDP ratio, just isolating the subsequent 2-year mean to eradicate the COVID counterfactual, we had a durable, or the transit, or it wasn't transitory, it was durable, by the way, but we also had COVID and everything else in there too. So, but just isolating that, we had a durable positive shock to federal debt. So all 5 of these Republican tax cut programs in the post-war U.S. economy created durable positive shocks to federal debt. 4 of the 5 created durable positive shocks to the federal budget deficit, and only 1 of the 5 created a durable positive shock to growth. So the record on these tax cut programs is atrocious. I don't have another word to describe it. So let's move on. As much as we would prefer Steve Moran's lullabies to be true, the thought of levering up to grow our way out of our fiscal mess seems preposterous to every credible source outside of the White House. So the White House Council of Economic Advisors released a paper a couple weeks ago. Hilarious. It was actually last week. They're hilarious assumptions in that paper. Don't even waste your time reading it. No offense to Steve Moran, who is brilliant, by the way. I have a tremendous amount of respect for Steve Moran, one of the smartest people in the world. But I think he's getting paid to say some things, and that is what it is. But they think the projected debt to GDP ratio in 2034 is going to be 94%. The CBO thinks it's going to be 124%. Committee for Responsible Federal Budget thinks it's going to be 127%. Penn Wharton budget model is going to be 125%. Our friends over at Yale Budget Lab is going to be 125%. So right now it's 117%. The White House Council of Economic Advisors thinks it's going to go down to 94%. All the rest of the other smart people in the world think it's going to go up to a mean of 119%, which includes their ridiculously low forecast, and a median of 125%. So everyone thinks it's going to add about roughly, let's call it on a median basis, 800 basis points to the national debt to GDP ratio. I don't know whose side, in my opinion, I think you would have to be viewing the world through some very red colored glasses to assume, to believe we're going to lever up and grow ourselves out of a debt problem. I mean, that sounds like that's crackhead math, folks. And trust me, I grew up with crackheads. I know what crackhead math is like. And this is it. In fairness to the Trump 2.0 administration, tariffs are likely to remain a powerful force for offsetting the cost of the one big ugly bill. So I got to give them credit. And they're not getting enough credit for this in the media. Everyone keeps talking about tariffs in terms of the economy, but no one's talking about tariffs in terms of the actual budget. So if you look at all these forecasts from, again, same collection of agencies, including the CEA, the CBO, the Committee for Responsible Federal Budget, Joint Committee of Taxation, Pentagon Budget Model, Yale Budget Lab, if you sort of take all their sort of raw and dynamic forecasts for the one big beautiful bill in terms of the impact on the deficit, and then you add their expectations for what the tariff revenue collection would be, and just look at that on a combined basis, on a median basis, it's kind of netting out to zero. On a mean basis, it's actually minus $1.2 trillion, but what's dragging down the mean is this absurdly ridiculous expectation that the one big ugly bill and tariffs are going to cause the deficit to go down by $7 trillion from our friends Steve Moran and Kevin Hassett. Guys, put the crack pipe down. This is nuts. But I will give them credit for tariffs are going to offset a decent amount of ABA or the one big ugly bill. So, it could be a wash on a net basis. I don't know. If they boom the economy, it's going to be a wash. So be aware of that. Smoot-Hawley level tariff rates are an egregious or hilariously regressive tool to finance tax cuts that largely benefit the wealthy and corporations. So this is analysis from our friends at the Yale Budget Lab. This looks at the distributional impact of the one big ugly bill relative to the tariff policy. And so if you're in the first income decile, you're going to lose about 7% of your annual after-tax income as a function of this in terms of the loss of goods and services from the government and obviously the tariffs. If you're in the top decile, you're going to actually gain about 2%. And so as you can see, it just skews higher and higher in terms of the black dots. The black dots is the net of the tariff impact and the one big ugly bill impact. So, we're going to tariff the poor people and kick them off of Medicaid and kick them off of food stamps so we can give the rich people more money to buy stocks. Slashing benefits for needy families as a source of funds to finance tax cuts for rich people will not fix the K-shaped society problem either. So if you look at the share of U.S. federal budget outlays on means-tested programs on an annualized 2025 basis, they're at 17%. 46% is Social Security, Medicare. 37% is everything else. So interest, national defense, everything else. This everything else does not all go to rich people, but what we know is that a decent amount of it does, as evidenced by the very popular WWE style feud between President Trump and Elon. President Trump and Elon just told you everything I'm telling you on this slide 105 is that the rich people they make billions from the government. When we were living in homeless shelters and motels and occasionally in vans and struggling in the projects with no heat or hot water or and all these other things, they weren't handing us billions of dollars. Now, I wasn't putting rockets in the air, so they shouldn't have been. But the point I'm making is part of the reason we had K-shaped a society is because the government hands rich people billions of dollars and it hands poor people 17% of the federal budget. So if we keep this up, we're not going to fix the K-shaped problem. And in fact, the pivot from paradigm B, which is shrinking all of this, everything else, because it's been the fastest growth in the change in the budget, the lurching in the fiscal dominance has been driven by the everything else category. You look at the change in the annual outlay from 2019 to 2024, $1 trillion, the change from the average annual outlay, from 2019 and now is $1 trillion. It's more than Social Security, Medicaid, and way more than the amount of money, incremental money the government's spending on like Medicaid and SNAP and all this poor people stuff. So if we keep this budget deficit pumping, we're going to keep pumping money to Alex Karp and Elon Musk and whoever runs Boeing, whoever runs Raytheon, whoever runs General Dynamics, whoever runs all these companies like Booz Allen and all these companies that sell services to the government. We're giving rich people trillions, not billions, $2.7 trillion this year. It's not all rich people. Not all the money goes to rich people. It's like Department of Education, all this other stuff. But again, a significant chunk of it is going to people and businesses at the top part of the K. And this is the problem. And the reason I'm ending on this is because I don't think investors in the bond market today paying 4% in the bond market understand the long-term implications, the fourth turning style implications of preserving the K. If we don't go our way out of the debt and we preserve the K, if you think this Mondani guy is a one-off, and he may be a one-off, I don't think he's a one-off. I listen to the guy talk. Like, I'm not a fan of socialism at all, but he's very impressive. Listen to him talk. He's impressive. He kind of reminds me of a young Obama. Now, again, I don't agree with a lot of things Obama said or did either, but he's got that pizzazz. Can you imagine him teaming up with AOC and winning the presidential bid in November of 2028? Because I can. Because if we preserve the K and we fail to grow our way out of it in a way that eradicates the K, then guess what's coming to a U.S. government near you? Socialism. If you think the bond market has a problem with the current set of policies, try socialism. So this is my point. Term premium at 64 basis points are, not even close to where they used to average. They averaged about 1.9% prior to the era of monetary dominance. So if you subtract the deviation from the mean from term premium from the current rate, you're talking about a 10-year Treasury at like 5.9 to 5.59%. I wouldn't buy a bond until I see 5.5 on the 10-year. Period. There's no point in buying a bond, because as long as we stay on this path that preserves the K, you got to assume that there's going to be political volatility. So right now we're trying paradigm C to fix the problems. They might try paradigm D, which is socialism in 2029. It won't work, by the way. Socialism does not work, but they might try it. The electorate might get fed up enough about everything I talked to you about in the modal outcomes section, and they've said for the crippling inequality that contributed to the chart, or the electoral college map color on slide 36. Imagine that map on slide 36 being all blue in 2028 because this stuff didn't work. And that's the risk to the bond market that no one's talking about.